Let me just. Hope.
Yeah,
I hope people can see my slides. Zoom is showing me some stuff about recording, but I hope that's not blocking all of your slides.
Yes, we can see you perfectly.
Perfect. So our story, our very quick, brief introduction to our company and our alternative funding journey. First of all, ShareTribe, we build software that helps founders to build online marketplaces. That is best explained through an example. We focus specifically on the so-called sharing of economy and the like. So examples built with ShareTribe include the Airbnb of X, so various share or rent like properties or items, like for instance this one from Australia, which is about hiring trailers from other people. Then naturally we have lots of the eBay for X, so buying and selling pre-owned items, like this one from UK, which is about kids' clothes and other items. This is an Etsy for X, so in this case Etsy for art, Sugarlift based in the US. And then we have also the Ubers for X, in this case, that would be handpicked tutoring. So there are more than 1,000 founders who have created a platform like this with our software. And what we want to do, why we exist in the world, is a purpose of democratizing platform ownership by making it possible for anybody in the world to build and launch a successful marketplace business. Because what we see is that today the world is kind of like a bit dominated by the couple of giant VC-funded Silicon Valley debt stars, and which obviously have created some great innovations, but at the same time they are also causing myriad societal problems. And like we much rather would like to see a world that looks a lot more like this, with thousands of local, more sustainably funded and governed platforms thrive. And that's what we're really trying to help make happen with our software. But when we were talking about this mission in various events, like we would often get this question that what actually like prevents us, ShareTribe, like becoming one of them? And this was a really good question. In the early days of our business, we actually were structured as a traditional startup, and we also took some early stage VC funding. And so really, like, honestly, we didn't have a good answer. Like maybe we would become if we would become a huge unicorn, maybe we would actually become just another extractive player that actually like ends up like creating more harm than good in the end to the society. While having to maximize profits. And that's when like struggling with this conundrum, we discovered this concept called steward ownership, which was kind of like an old way of like structuring companies, but packaged in a bit of a new way by this German group. Basically, like this is just but there are like two main principles of steward ownership. First is that companies should be purpose oriented, meaning that like profit should be only a means for achieving that purpose. And the other is that they should be self-governed, which basically means that they shouldn't be owned and governed by outside shareholders, but really people who are working at the company or otherwise close to it. And we ended up like implementing this structure, and that naturally like posed us some like interesting challenges when it comes to fundraising. So how do you raise funding when you have a company that actually cannot be sold, or can it also be taken public in a traditional sense, and also where all the returns to shareholders are capped, so you cannot earn more dividends or other returns than that up to a predefined cap, because these were the things we put in place to ensure that the company would always remain independent and mission driven. And our solution ended up being a model of redeemable shares, which basically meant that we would be issuing shares worth 20 euros each. And when you buy those shares, then our company would be using 40% of its annual profits for buying back those shares. So they wouldn't have any voting rights, but still, like, you know, if our company would be successful in making profits, you would make a solid return of 5x. So this was kind of like a model that is somewhere between like traditional like equity and loan. And it ended up working really well for us. So in May 2018, when we transitioned to this model, we raised a crowdfunding round, and more than 400 people from 42 countries ended up investing, and we raised more than 1 million euros. And we actually ended up buying out the shares of our earlier venture capital investors, because naturally they were not super happy with our transition, as obviously they were still hoping that we would become a unicorn and they would make a 1000x exit. And when they realized that wouldn't be happen, they were worried. So then we had to buy them out. But thanks to this funding, we were able to do that and become independent. So just like quickly on the on like how our fundraising path looked like, we discovered steward ownership, and with that we also discovered this organization called Purpose Ventures, which is our anchor investor in the campaign, who basically only invests in steward ownership owned companies, and they did a thorough due diligence with us. And then through that process, we then decided that we are going to complement this with crowdfunding. That meant including a process of actually like first going through a more traditional fundraising process, even though our like structure was untraditional, but we still approached many funds, angel investors, and also like individuals through our own community before we actually launched the public campaign. And this approach allowed us then at the launch of the campaign to get to our minimum target of €500,000 in 4 days after launching the campaign. So it was really, but I also want to stress that it was lots and lots of pre-work that went into the campaign to make it a successful one. So that was a very brief introduction from me. Looking forward to having the discussions with all of you today.
Thank you so much. Thank you for giving that context. As you can imagine, there are loads and loads of questions already based on that. But I think something that was really significant for me, that question that you asked right at the beginning, is how can you make sure that you don't become the type of business that you're trying to, you know, stop existing in the world. So I think that's fantastic. All right, over to you, Emma.
Thank you. Yeah, hi everyone. So introduction to me, my name is Emma and I'm one of the co-founders of Library of Things. And my big passion is really about the deep design of business and how, you know, the business model, the ownership, the leadership can be something which is creating good in the world. And as I started my career as a plant scientist in environmentalism. So for me, that's about business coexisting with preserving the natural world. And that led me to create a company, the Library of Things, in 2014, which is all about creating a very desirable alternative to wasteful consumerism. So rather than buying things like drills and sewing machines that you use once or twice a year, why not rent them from somewhere local? Why not learn how to use them along with your neighbours? And so really we're a catalyst for behaviour change and growing that at the moment in the UK. And so in terms of our funding journey, we started Library of Things as a completely bootstrapped, volunteer-run, non-profit, standard-ish company, which we ran for 4 years and hopped from one grant to the next and never could really plan more than 6 months ahead. And we weren't really growing our potential. And so in 2018, we restructured, went through a co-design process with a lawyer and a social investment advisor, and said, much like Juho, we didn't know about steward ownership, but really we've come up with a structure that's very similar. There's a few differences, but we have a for-purpose, we're a for-purpose company. We have a mission lock. We have something called a guardian share. We can raise capital, so we have investment shares, but we keep the control with the directors of the company. So our investors have non-voting shares, for example. With that structure, we raised our first kind of early pre-seed round, £500,000 from 22 individuals, one institution. That lasted us for 2 years whilst we were growing from 1 to 7 libraries of things in London and building our technology and our platform to make that possible. And this year we've raised £1 million with that same structure. And we have 275 investors because part of that has been equity crowdfunding, which has really grown our investor network. Maybe just to speak to why we didn't go down a traditional route. A lot of that was to do with independence for us. So I have 2 co-founders and we have always been on the same page that we want to create a long-term sustainable, healthy revenue generating company where we're doing that for our mission, and we're doing that in a way that we're focused on the business model, not necessarily just selling the company for an exit. So we want to really build the business. And secondly, in terms of ownership and control, we wanted that to be held by the team. So not just co-founders, but those closest to delivering that mission day to day are the ones that know how to make the best decisions. So we wanted that ownership and control to stay with the team. And what that meant was actually when we started going down whether it was the grant route or debt or venture capital, that came down in some way or other to losing our independence, whether it was serving a VC's exit ambition or a grant funder's mission, like, you know, we're sort of working for them, it felt. And so we sort of accidentally ended up raising non-traditional funding, but it wasn't like we set out to do that. And I think the second reason is in trying to do the traditional route, we realized that we were losing our integrity and in one way or another compromising it or selling out, or, you know, being beholden to this other stakeholder that really had power over us rather than shared power. And we couldn't find the right kind of collaborative funders and partners to do that with. And so we did it a slightly different way in that we, you know, our offer is really about our investors commit to putting the mission first before financial interests. But as a result of us delivering that mission and delivering our purpose, we can share in the financial success of that with them. Because, yeah, you know, they're giving money, there needs to be some kind of an exchange. But rather than it being a get rich quick or we'll make you millions, we talk about a fair return. So Library of Things has many stakeholder groups. We have our community of borrowers, we have partners, we have the planet, and we have investors. And the investor interests can't come before everyone else. We're sort of empowered to balance those interests and do that in the right way. So yeah, there's lots of detail around that, but that's the kind of essence of what we were trying to do. I guess in terms of how we found those 22 people at the beginning, the one institution, and now 275 crowd investors, I think the headline of that experience has really been networking, like, you know, just going out there, getting connections to connections to connections. I agree with you, Juho, that a crowd campaign is really about what you do offline. It's not really, the platform is just where it makes that visible, but the work kind of happens behind the scenes. But I would say that whilst we've been successful in getting, growing this network, it sort of feels like a friends and family plus round, in that we've grown this network quite organically of individuals who share our mission and want to be part of that. But the maximum kind of individual investment we've got is about £50,000 from one individual. So we're sort of getting lots of people putting in £10,000 to £50,000. And what we've not cracked yet is unlocking that bigger institutional money. So I mean, sort of like in the hundreds of thousands plus, whether that's from family offices, trusts, kind of mission aligned funds. We haven't found those yet that exist in a way that they'd agree to our terms. And so that's really what I'm working on now, and hope to crack that one. But it's a biggie. I'll hand it back to you, Esme.
Thank you. Yeah, I think there's so many takeaways even from that. I think it's in this session, you'll hear a lot of like details, a lot of specifics, maybe words you're not familiar with, which, you know, we can send you lots of resources and ways to understand what that all means. But it's more about the process and the approach that they used. You know, I think both of these stories have parallels. You know, they started off in a very different place in terms of their legal structures, in terms of even what funding they took. They went down the VC route. They learned a little bit. They thought about where, you know, and perhaps they wanted something different. They pivoted and they changed, and that is totally normal in a business, as long as you know how you might move from where you've got to. So just something to think about. All right, I know we've got loads of questions in the chat. I am gonna start off actually with a question that we got a lot from participants around the struggles around fundraising. And specifically, Emma, we had a few questions around that, sort of the gender dynamic and the struggles around fundraising as a woman. And if you want to speak to that first, and then we'll go to Juho about his fundraising experience.
Yeah, so Library of Things we have 3 women co-founders, And then we also have this unconventional structure that we're talking about, where we're putting a purpose before kind of wealth creation, if you like, even for founders. And so there's definitely a dynamic between those two, because both are seen as non-commercial, or can be seen as non-commercial. And it's hard to know how much it's the gender thing at play or the kind of alternative purpose thing at play. But there is definitely a gender dynamic with fundraising, and particularly the first time we went out to fundraise, where we didn't have a track record of raising money. I spent a lot of time at networking events that felt like being at my dad's work do or something. It was just very specific demographic of generally older white men who hold a lot of capital, who have the free capital to invest. And so the challenges with that, I think, is being ambitious. I think fundraising is really about hope, telling a story of hope and sharing that, like, you can be part of this. But it never felt authentic to us to be aggressive in terms of world domination and like a kind of Silicon Valley narrative around like be the next unicorn. And so the trick was about showing that we were credible and had a track record of building the company before going out to fundraise, and that we were ambitious, but it's often seen that we're not. And I don't know whether that's because we're talking about making you a fair return on your money, or whether it's because they don't believe that we're going to be the ones to deliver it. But I think that's been the biggest challenge. And just to give one example of that, where it can go wrong, I guess, so in raising money more recently during COVID times, a lot of it was online. So in one particular event, it was on Zoom. There was 25 or so angel investors. We delivered a pretty banging pitch. We'd rehearsed it. It like went all to plan. It was really engaging. It was ambitious. And what happened was one particular person in the event had latched onto this fair return. What do you mean a fair return, not a 10x return? And it completely sidetracked the conversation. We got accused of not being ambitious, of asking for philanthropic money, and asking for a donation. And I think that is an experience that in different ways has happened numerous times, where a lot of it's about kind of telling a story around risk and reward and how that can be hopeful, but where you're not promising them the world. And I think a lesson for angel investment in particular is that where you're pitching to a group, there can be a kind of pack behavior where they're looking to each other for sharing that kind of vetting process. But if one person latches onto something, it's quite hard to not let that affect the rest of the conversation. And yeah, I think that would be because it hits on the like, are you not believing me because you're not confident in me, or because of the type of business we're presenting? I think that was a pretty like good example of where it's been challenging across the board.
Yeah, I think that sort of experience is definitely resonates with a lot of people, that particularly women that I speak to. Juho.
Yeah, I definitely like kind of like also in our case, like if I think about the biggest challenging interactions like during the fundraising, those were so there were a couple of like really nice impact funds and like really nice people in them who we talked to. But with the models, they are like structured, and with the type of like exit expectations, it still just really wouldn't work if you say that, okay, you're going to get like a 5x exit. And then they like kind of like still like even in so often, even if it's like kind of like a really, the fund says that, okay, we are an impact fund, we are focused on impact first, but at the same time, they're usually quick to point out, but at the same time, we really expect just as big returns as like all other VC funds. And because we have the same expectation than other VC funds, which is that 90% of our companies fail and 1%, the 10% need to provide basically all the returns from our fund. That means that the size of that return that needs to be like 30x plus of like what they invested, and which like becomes like really quickly unreasonable to then provide actually like during company's profits. So you really need to only can produce that through a company sale or an IPO. And actually, it was definitely challenging for us to walk away from some of them. Some of them say that we really want to invest in you, but you really need to abandon this plan for transitioning into this structure and do a traditional structure. If you're going to do that, then we're going to invest. And we're like, no. and obviously that was challenging at the time when we were not really sure if we would actually be able to raise this money with this new structure. And we also had a challenging situation because our earlier investors demanded that they need to be bought out to allow us to transition. So basically, if we actually needed to raise a minimum of $500,000, otherwise, basically, like our fundraising would have failed completely, wouldn't have gotten any money, and also our transition to the new steward ownership structure had failed because of our earlier investors. So it was a challenging situation, but luckily we found people who wanted to invest. And
yeah, I think, I think you're both really brilliant at being honest about how difficult it is to take that extra step and do something that's really different, particularly with your governance structure, and that really difficult conversation to be had where you're saying no to money, but a really important one, because later on is to your advantage not to have people, investors on your cap table as part of your business that aren't entirely aligned and entirely understand how you've structured your business and what kind of returns you'll be able to provide for them. Juho, you mentioned at the end of that, finding the right investors. How did you go about finding these investors?
Yeah, I think actually, like what I think some people in the chat already like pointed out, like if you choose your structure, you structure your company and your fundraise in a very specific way, and in a way that funding is completely aligned with your purpose of your company, that is actually a really great way to find the right investors, because because if those people who are not right for you probably won't invest. It's just because like if you can get the incentives right, then you can be sure that the people who will invest also like will well they will invest because like they have the same incentives than you. Naturally, like in our case also, it depends a bit on like how you structure things. In our case, this was all the investors would get non-voting shares, because that was one of the elements of our of our approach, which basically meant that like like if there would be some like personality clash or like some hostile takeover attempt later, like that would not be it would not be possible for investors to do that. But we really did notice is that obviously, like in those conversations, it would become clear that, okay, if somebody doesn't believe in the model that we are using, clearly they are not the right investor for us. And at the same time, in the end, there were at least like 400 plus people who believed in that model, and for various reasons. And for instance, one angel investor I remember told me that, okay, so this is like 5x return in 10 years that you're trying to give. And that basically means 17.5% annual return. Like if you like translate that into just annual return, that's way better than stock market. And it's also way better than actually any Finnish angel investor is making for their investments on average. So if you're able to produce this return, like that, it actually is better than an average return than angel investors are making. So this is a good deal. And that showed, I think what somebody pointed in the chat like is that it like basically it's a bit of a lack of imagination from the investors also, like if really they think that there's only one model. But you really need to look more deeply as to, okay, what is actually the probability of the return? And for instance, in our case, we were already very close to profitability. Since the fundraise, we achieved profitability. So the beauty of this model is that actually the return we promise, we don't need to become huge unicorn like to achieve that. We only need to become like, we need to grow a bit bigger and like make bit more profit, but really not that much. So it's really also way easier than for actually us to like provide those returns without having those like excessive growth pressures.
Yeah, I sort of two bits really stood out for me there. I think the fact that actually, although it's challenging to have a different type of model, it does, because it limits your opportunities, it perhaps makes it easier to find them because you're very targeted with the type of investors that you are looking for. How about you, Emma? How did you find your investors?
Yeah, similarly. I often think, so there's two analogies that come to mind with this process. One is dating and the other is recruitment. And the way we went about it was to be very intentioned about who we were looking for. So if you like, your kind of your deal breaker things, and then your nice to haves. And so, and we actually wrote that out like a scorecard. And when we sent out emails to investors, we would say, hi, we're Library of Things and we're looking for XYZ. Are you that person? Do you know somebody? This is what we're offering. Can we chat? And it meant that when we had situations like what Juho shared, where we were being, the individual or the investor was saying, we want to invest in you, but these are our terms, we could say, right, well, is that one of our deal breakers, or is that something we can negotiate on? And for us, that was a combination of kind of hard terms, like we have a guardian share in our legal structure, which is kind of like an absolute fail safe that as the company grows, we stay true to the mission. And so if we were to sell the company, that is actually possible with our structure. It just has to be in a way that furthers the mission. And so that guardian could veto it, for example. And that was one of the main deal breakers that we had with funds in particular, is they would say, we'll invest, but we want you to be able to sell this to the biggest, the highest bidder, regardless of who they are. And so we turned down quite a few investors for that kind of term in particular. And then some of them were, I guess, softer, but more kind of values alignment. These are people you're going to be working with. So it's like a marriage. So you don't want people who are going to be, for example, for us, we didn't want people who were going to be really involved in the company, wanting to chat every fortnight, like asking us to do stuff. We wanted them to trust us to making the right decisions, but that we could go to them for advice on certain things when we needed it. So we laid that out also quite clearly. We're looking for people with advice and networks in retail, tech, operations. So we brought on people like former chief operating officers of, like Just Eat or like, these kind of platforms that would be really useful for expertise. And I think the other way that, I guess this process was about, finding people that had the same expectations as you, but it's different depending on the stage you're at. So the first time, we'd never raised money before. We had bootstrapped and run a company to profitability for 4 years, but so we could say we've done this, there's traction. But the first time round, we're saying this is all a bit of an unknown. Whereas the second time round, we could go back and say, look, we did it. We raised 500,000 3 years ago. We delivered exactly what we set out to do. Now we're raising 1 million to do this. And for people who were unsure that we would be the right people to deliver stuff, we could just point to the evidence, and that really helped the second time round. So I think, whether that's from a kind of women point of view or just like early stage company point of view, pointing to whatever traction you have is like, we're the right people to do this. And I would say that's the primary reason people invested, was that it doesn't matter what was going on with this funky structure thing. They kind of trusted that we'd work that out, but they wanted to know that they would back us to do it. And I've heard that from most of our investors, that that's the reason they invested ultimately.
Fantastic. All right, so we've got a few questions around converting to steward ownership. I like to clarify, Library of Things is not steward owned, but they do have an interesting governance structure. But perhaps, Juho, do you want to sort of respond to these questions about how difficult is it? How long does it take? Do you think it's worth it?
The transition to the steward ownership structure specifically, yeah. So in our case, actually, the actual like transition and like coming off with the paperwork, I think we ended up like really like completing it within a period of a week, because then we realized, whoa, actually now we really need to launch this campaign very soon. So we did end up paying around 10,000 euros for a lawyer for the paperwork, which is definitely like money. So in our case though, so it definitely like helped like that we had been interacting with the Purpose network, and through them like we got a sample like articles of association and documents and so on. It's just that nobody else had ever done it in Finland, and because of that, like we needed to adapt a bit to the local legislation. But in the end, like the change is still like we're not that massive. It's just that lawyers charge so much per hour. But yeah, still definitely, I think the situation is getting better all the time. For instance, I shared earlier in the chat a link to our official documents. Feel free to take them and use them. They are available for anybody to really like use and adapt. Again, they are based in Finnish legislation, so you probably will need, if you're not based in Finland, you'll probably need some local adaptations. I think Purpose now has probably already templates for many different countries. So when situation gets better there, then also like this becomes easier. But yeah, and I definitely think that would be like a consideration. If I noticed there was a question about like, you know, like at which stage should you like do this transition? And I think that on one hand, it was more challenging for us when we were more mature because we had already like taken some investors and actually they were not really fond of this. So we needed to negotiate a lot with them and actually buy some of them out. On the other hand, though, like it was way easier for us to raise this funding when we had traction. And like, I don't know like how it would have worked if we would have actually like gone pre-revenue and like pre-traction and like tried to raise money with the same model. It might have been, or for sure it would have been way more difficult. And actually then sometimes it can be easier to kind of get some investor who thinks that maybe, okay, this is very risky, but maybe I'll get like 1000x return. So sometimes those conversations can be naturally like a bit easier. So it might have been that we would have had to find a way to bootstrap way longer before like raising money in that scenario.
I don't know if you have anything to add, Emma, on your experience in the UK context.
I suppose in the there is a kind of difference that I'm actually still trying to get my head around with steward ownership, as is quite strictly defined in the German context, and especially with this kind of the Purpose Foundation. We've taken inspiration from that model, but there's just differences in terms of kind of shareholder rights and tax and all these kinds of things. So it's difficult for me to direct compare and contrast. But for example, with our model, it is very possible that if Library of Things did really well, that our investors could make 10 times their money. It's just, that's not the intention we're setting and the promise we're making. We don't have a hard cap on what they could earn. The main thing for us is to basically ensure that any kind of return on investment, or if there is some kind of exit scenario, that is furthering the mission. Yeah, and yeah, I think that's the main thing.
There's been quite a lot of questions around when is a good time to fundraise. I know that we've spoken about this before, Emma, around when Library of Things decided they had moved from grants, bootstrapping into actually need a larger amount of capital, and what that felt like, so people can see if they're at that point or not.
Yeah, there's definitely a tipping point, and I think you probably know when you get there. But there were also some comments about bootstrapping, and at least in our experience, that, like, and my opinion is the most useful thing you could do is bootstrap, grow the company through revenue for as long as physically possible. Because if at that point, you know, you just need an injection of cash to do, whether it's tech development or recruitment or whatever it is, to really build capability, you know, you've exhausted, you've kind of worked on the business as hard as you can to get it to that point, and it's absolutely reasonable that you'd need a cash injection, but it's not the first port of call. And to be successful in fundraising, demonstrating that you've got traction, you've got customers or potential customers, and that your costs are kind of relative to that is essential, because you'd have people looking at the financial side of the business. So it's not, yeah, I think bootstrapping as long as physically possible, and then fundraising if that's the only option at that point.
Thank you. Okay, we have a question from Vicky. Also, thank you, Juho and Emma, for answering some of these questions in the chat. I know that we have a lot of questions. I'm going to try and get through as many of them as we can, and find a way that we can answer them for you after the event. But there's one from Vicky. Do you think it's easier to get a different funding model once you have that income traction, once you have some income and good traction, i.e. more difficult pre-revenue, potentially seen as too risky? on top of a different model. Anyone wants to take that question?
Yeah, I definitely think that that is a consideration. Like, it's this thing that even though like we ended up having those challenging conversations with our investor, like original like VC investors, and ended up buying shares back from them, at the same time, I cannot be certain that we would be where we are today. Like if it weren't for that money that they were willing to put in on our company in a very early stage, and that was hundreds of thousands of euros when we were making like some thousands per month of revenue, like and vastly like unprofitable. And like knew that we need to build quite a lot of tech to actually get to a place where we can like be funded by our customers. So definitely that can be like a consideration, and and because of that, it's kind of like a bit difficult for me to say exactly like how we would go about things, like if we would do it again, because I definitely like I would like to be. When we did it the first time, we didn't even know in the beginning, like, that this type of structures existed. We basically thought that, okay, this traditional startup structure is the only thing. So we just say that we are a social enterprise, but what's wrong with the unicorns and exits? And only later we realized that, okay, actually this is not at all what we want. But then at that point we had already raised some money. But now if I do it again, obviously I know from the beginning that, okay, I really don't want to go with this model. So then we definitely we couldn't go with that. But definitely it would be challenging, and again, just like Emma said, that really like I would just be more thinking about like, are there new ways to bootstrap, and luckily like I feel that overall like bootstrapping a business is just becoming easier and cheaper all times. And I think people really these days like don't necessarily even realize like how little tech you actually need to build to get like a technology business going. There are all those like no code tools and like various guides and like ways for you to just kind of like a bit of this like fake it until you make it attitude, just doing some things like manually behind the scenes. So you can just really do lots of things to build that initial traction. And that would be my advice actually for many people. Just really keep the control 100% for yourself, like, and figure out a way to actually get to a state where you are, as said in the startup world, sometimes ramen profitable, meaning that the smallest amount of money that somehow keeps you alive. And then it's so much easier to go into those conversations, no matter what your model is. And at that point, it's also easier for you because you really know that, okay, you have something going on here. This thing can be sustainable. So it's also then easier to justify the investment.
Yeah, absolutely. And I mean, I have conversations with founders every single day who, are looking for a large amount of money very early on. And the larger amount of money and the earlier you are looking to get that funding, if it's sort of, equity or something beyond grants, is going to be really, really expensive and really, really risky, and very, very challenging. Whereas if you take your time, and I know that it's not easy, we're not saying that any of this is easy, but it will ultimately put you in a better position if you're able to bootstrap or be reliant on grants until you've really got yourself in a solid position to be able to really dictate the terms. I think that's a really important bit. Emma, we've had a couple of questions around, and I wonder if these are sort of UK specific questions, but around limitations on getting grant funding or social investment given your structure. I don't know if you want to speak to why you designed it in a certain way and what limitations there are.
Specifically with grants?
Yeah, it was a question on grants, but also social investment, I think wider as well is quite interesting.
Yeah. So we're a full purpose company, as I said. So that's the reason we exist, is to develop that mission. But we can make profits, we can distribute profits. So if you like, we're also a for-profit company, and kind of in a traditional sense. Well, that's how people kind of like to divide things, non-profit or for-profit. So because of the for-profit ability, we can't take, at the moment it's difficult for us to get charitable grants from traditional kind of charities and trusts and foundations, because their own constitutional remit is that the money that they donate or invest has to, for example, there's like a charitable commission in the UK, so has to alleviate poverty, it cannot lead to private wealth creation unless it's kind of incidental and that, you pay wages or something. So we don't fit that. and we talk at length and lobby and rally and negotiate and say, but look, you know, we exist to create good, and this will create huge impact and outcomes. And to be honest, the wealth probably will be incredibly incidental, but maybe it won't be. We can't guarantee that. But that's kind of written in law, so it's difficult for us to budge that at the moment. But that narrative, whether you're talking about charitable grants or social investment, and I think, you know, social investment in the UK is also a very niche, limited world, in that it's mostly those same trusts and foundations with investment arms, where they're looking to get that money repaid, so they therefore need to see how you're going to repay it. But they very much take a lens of, so we generally get challenged on, like, are we pretty much tackling poverty? Are we trying to alleviate poverty in the people who are using Library of Things? And that is a significant amount of our people who use the service are primarily doing it to save money, but it's not exclusively for them. And so again, like, we haven't been able to crack one of these institutions, although we're very aligned on many of their mission areas. It's kind of like a T's and C's point that we can't tick at the moment. But in terms of grants, for like R&D and innovation, yes, that's completely eligible. So we're building tech, so that's eligible for that kind of funding. And impact investment, I guess, which is not social investment, or there's all these different terms, but generally impact investment is more from the kind of venture space. That is, we would be eligible for that. It's just more that, again, they don't tick our criteria, because generally they're looking to make a huge return and make some incidental impact. So we're in the middle of those.
I don't know, Juho, if you have anything to add about funding.
Yeah, I guess it's a bit similar story on like us also. So we are a for-profit company, which means that charitable grants are not really like a tool that works for us. On the other hand, like, you know, like if you have a VC fund that is structured in a way that they just expect the, you know, like 30x plus like return, that doesn't really work for us, like, because those returns really can only come through a company sale or an IPO, and those are and neither of those can happen. We actually have this foundation set up in place to ensure that even if we change our minds, there's just no way for us to do so ever. So it's a pretty ironclad setup. So that just rules out certain options. But naturally, on the other hand, like because of our specific structure and mission, there might also be quite a few people who only want to invest in that types of businesses who they actually believe are doing something good instead of the traditional ones. So you win some, you lose some.
Yeah, I think that's a good way to summarize it. Like any funding option you pick, you're going to, you know, limit some option. You're going to remove things from the table, but if anything, that's possibly more useful, because then you can really target your efforts. And it's more thinking about where you're trying to be. But I have seen more and more businesses explore these sort of hybrid structure where you're for profit and you've got a non-profit arm, so you can get both those types of funding, which is definitely becoming more common. All right, so we've got 8 more minutes. Thank you for all your comments and all your questions. If there's a question that I've missed, please add it again and we'll try and get to it. If not, I will continue with my questions. And thank you for sending all the resources. Yeah, there's lots and lots of resources I would definitely recommend. Ani's book, Venture Finance, it goes through lots of case studies. I see people nodding. I think they've already read it, which is brilliant. And lots of, Juho also shares a lot of really, really good resources around marketplaces and funding options, and I'll put that in the email when we follow up. But if you've got resources that you find really useful in your funding journey, also put them in the chat, because there's so much out there and everyone brings their value and everyone has really useful resources that they can share. Question by Sat: have you become B Corp? Anyone wants to answer?
We explored it. And to be honest, it's quite a big process to go through. We would be eligible. I would have to do the work to get the certification. We decided not to go ahead with that because we were just starting out with fundraising, and it doesn't. I think it would be a nice to have for us. It would kind of demonstrate to our stakeholders that we could report on and have accountability that way to the kind of impact we create. But for us so far, it wouldn't have added loads of value. In a way, the structure that we have is kind of on that deep design point. It's much more transformational than B Corp, but it's a move in the right direction. And I think it does signal to customers, partners, stakeholders, investors that you're serious about mission. It doesn't go quite far enough for us in terms of how that's set up. We are a founding member of a different certification called the Positive Mark. It's kind of a regenerative business mark. I don't know if you're also on that, but we like those principles, and again, it's kind of a symbol, and it fit more with where we were at when we did that. But I wouldn't rule out B Corp in the future.
Yeah, same for us. Like, we also felt that the kind of the transition that we did with steward ownership, it was way more profound. Like, the problem with the certification is that you can just adopt it and then you can throw it away. In a way, somebody like Etsy, they took it but then they realized, okay, it's no longer really works for us, so then you just give it up. So it's not really kind of a permanent thing, whereas our thing is really a permanent, you kind of know that you cannot sell out, in a way, after you've adopted our structure. And that also gives us an incentive naturally to explore these things later. And obviously I feel that B Corp is indeed more about reporting and things okay, how do, and there's definitely there's some overhead. At some point we might invest in something like that, because just it might be useful that lots of different companies are just viewed through the same lens, kind of okay, how do they do the reporting and so on, and various things related to transparency and environmental at some point. But at this point we felt that it really didn't add that much to us. But especially I'd say that it's a layer we can add at some or other certifications, that we can add those layers on top of what this foundation that we built later when the time is right.
Yeah, I think that's really interesting. And thanks, Diana, in the comments as well, being they were B Corp, but now they've decided to not renew. I think, B Corp is there's a sliding scale here of how you can look at your impact and your mission and continuing that. And B Corp sort of perhaps over here, and as you go further and further, you've got steward ownership, you've got co-ops right down here, which is a very, really instilling all of that ownership and all of that governance right in everything that you do. And then you can move down that scale as you grow and develop and see who your users are and who you want to serve in your business. I think we've got time for one more question. Let's have a look. Okay, we've got a big one here. Is for profit, does it mean that legal structures enable? Is for profit, oh wait, let me read this question. Does for profit mean that the legal structures enables the owner shareholders to obtain profit? So for non-profit, does it mean that legal structures can still make profit but not extractable by the owner? So you're trying to understand the difference between for profits and non-profit, is that correct? So are you still for profit if owners can't extract the additional value? Trying to grasp those terms and what investors are looking for feels a big part of the journey. You're absolutely right. I don't know if you want to tackle that one, Emma.
Yeah, it's really about how you distribute your profits and what you use them for and who gets them. So if you're non-profit, you're still going to create a surplus every year, hopefully. It just can't leave your company. You'll be taxed on it, but they can't leave the company. If you have a for-profit distribution, you can distribute what you make in the way that you so choose to whoever you so choose to share it with. And investors is typically, the stakeholder group that people think about, but we have profit shares on a local level with partners. That's part of our business model. It's not part of our legal structure. But I think it's about who you make money for is important, I guess. And whether you want the power to decide that means that you might be looking at an alternative legal structure. If you don't mind making money for just shareholders, then you can use a typical structure.
Yeah, it's actually interesting for us because kind of at some point, if we succeed well, financially, that means that at some point we have bought out all the shares of our investors. And at that point, actually 100% of our profits will be used for ways to advance our mission in some way. So actually we cannot put any of that into the pockets of our shareholders. at that point, which basically means that, like, does it then make it as a non-profit technically at that point? Though, well, at the same time, we could still like raise more capital and then like equity, true equity, and then again, like, it would be a different situation. But still, like, it's not too far from that in some ways. Though naturally, we might have more options to decide, like, what do we do with that money? It could be used, for instance, to maybe we decide to invest in another steward-owned company because we think that's actually the best way to advance our mission, and maybe a non-profit company actually wouldn't be able to do that. So probably there's more flexibility, but at the same time, it's also like not super far in some ways.
Yeah. Oh, I've just noticed the time. I totally agree. I think there needs to be more language between for-profit and non-profit, because you can be for-profit and still make money and grow a sustainable business. But you can think about, as Emma was saying, who else do you want to serve in your business? Who should also benefit and own that business? Who should have a say in that business beyond just the typical shareholders or investors? That is all we have time for today. Thank you so much, Emma and Juho, for joining. Thank you for all of your questions. I'm sorry that we didn't get to all of them. I hope this has been a really inspiring session to see what's possible. And if you want to join the Alternative Funding School, do try and apply in the next few days. Thank you so much. Have a great rest of the day.
Thank you. Ciao.
Thank you. It was really great to be here. Thanks, everybody. Bye-bye.